Oh. All right, John, let's get going.
All right. Well, most business owners with a successful company believe that they're protected. They may have an LLC as their corporate structure. They might have an estate plan on the personal side, and they most certainly have a very good attorney. And in most situations, all of that is probably true. But there's a specific category of situation where all of that can unravel very, very quickly. And it is almost always the situation that no one has planned for. Welcome to webinar 4 of the Value Gap series. My name is John Heck, and joining me today, as always, is Mike Clark. This session is called Asset Protection in a Litigious World. Is your personal wealth truly insulated? And what we're going to cover today is the difference between having a structure and having a system. And as you'll see very shortly, those are two very different things.
Absolutely, John. And so good to be here with everybody today. So let me tell you exactly who this session is built for. So if you're running a business doing $2 million or more in EBITDA, I'm sure that you've built something significant, right? That's a very good achievement. And the assumption most owners at that level carry is that their legal and financial setup is doing the job of protecting them. Today, we're going to test that assumption. And for most of you, the answer is going to be more complicated than you expect. And so here's the deal, is that, as always, we have two goals with these sessions. First, I want to give you a clear picture of where your personal wealth may be exposed and what a coordinated protection strategy actually looks like. So that is the education side of this conversation. The second part is that if we deliver on that, we're going to ask you to book a complimentary conversation with us to look at your specific situation. So that is the ask. That's all we're asking. And I'm going to tell you up front because, I think you deserve to know what our intentions are in these webinars and to make sure that you get the information that you need to make educated decisions. So if what we share today is valuable, take that next step. If it's not, obviously there's no hard feelings. This isn't for everyone, but that's also why we do multiple webinars like this to make sure that it does fit with you. So if we have a deal, John, I think we have a couple guardrails we got to talk about.
Excellent, Mike. Before we go any further, let's get the compliance stuff on the table and out of the way. As always, everything we cover today is educational in nature. It is not specific financial, legal, or tax advice, and your situation has details that are unique to you and your business. And anything that we discuss here should be reviewed with your personal advisory team before you act on it. Mike and I are here to educate and to help you ask better questions of the people who are already working in your corner.
Love compliance. So before we teach you anything, right, obviously we got to get that out of the way, but I also want to name a couple things that a lot of clients that we speak to come to these conversations with preconceived notions as to why this is for them or why they're not. So I want to get these out on the table, get them out of the way, because if we do not clear these out of the way first, you'll spend the whole session arguing in your head about why this is not for you. So here's the first one that we hear when we talk to clients about this. I already have an LLC. My attorney set it up. I'm covered. And that is the most common one that we hear. And I understand why. Look, you paid for the structure. Your attorney is good, I'm assuming. And for most day-to-day situations, it does the job. But an LLC is a fence. It is not a fortress. And the specific situations where it does not protect you are exactly the ones that tend to happen to very successful, visible business owners.
And the most common point of failure here is not someone ignoring their structure. It's someone who has a solid structure, but has a personal guarantee floating around out there somewhere. Often this takes the form of maybe a lease for your business, a line of credit, or equipment financing that maybe they have signed for many years ago and haven't thought about it since. That's pretty common. The single document can reach right through what some refer to as the corporate veil that you may have already set up.
And that is the one that stings, right? You built this fence, then you left the gate open and you forgot it, right? So this is what we're going to kind of talk about here. So the second one is that this sounds like it's for people with $50 million. That's not me. And here's what I know from working with business owners at this level. The $2 to $10 million business range is actually where the exposure tends to be the highest. I mean, you have enough assets to be worth pursuing if something were to happen, but you're not at the level where you have a full legal team and financial team watching everything. And that is the gap we're going to talk about. And so the third is my attorney handles this. I trust them. And I'm going to tell you good, because you should. If you don't, you should probably get a different attorney. But here's the question worth asking. Is your attorney talking to your CPA? Is your CPA talking to your wealth manager? In most cases, those three professionals have never been in the same room, let alone the same phone call. And the gaps between them, not the gaps in any one person's work, but the gaps between them is where wealth tends to disappear and be exposed.
And in my experience, each advisor typically does very, very good work within their specific domain. The problem is that asset protection does not live exclusively inside of any one domain. It often lives at the intersections between them. And these intersections require coordination, not just competence.
Absolutely. And so the fourth one, I do not want to be overstructured. Now, I understand the need for flexibility when running the business. It's completely valid, but nothing we're going to show you today requires you lock yourself into a rigid box. The strategies we're going to talk about and cover are designed to protect without paralyzing. So you can still run the business the way you want to run it, right? We're not trying to change anything. But before we get into that, obviously, I think it's important that you know who John and I are if you're coming to this webinar for the first time. My name is Mike Clark. Raised 42 million for a handful of businesses over the last 10, 15 years. Got my MBA, and now I work with business owners to help streamline some of these processes to maximize the exit so that their net worth that is tied up in their business is actually pulled out when they need it.
And after being in financial services for more than 3.5 decades, and helping my clients acquire, protect, and transfer wealth, what I kept seeing was business owners who had excellent individual advisors and still ended up with significant gaps in their planning, both on the business and the personal side. So what I've become very good at through the years is translating the technical side of what we do, the mechanics, if you will, of entity structure, trust design, coordinated planning, into a language and a strategy that business owners can actually understand and implement. Think of me as the protection layer. Together, Mike and I are going to cover some ground that most advisory relationships simply leave open.
Perfect. So here is the core problem with how most business owners think about asset protection. They think of it as simply a checkbox, right? An item on a to-do list. So you form the LLC, done, check it off the box. Maybe you have an estate plan, awesome, done, check it off the box. And all of a sudden you think you're protected. But that mental model feels right because you did something, you took action, you did what the professional told you to do. And a system, and this is where the problem lies, the system only works when all of those pieces are connected and talking with each other.
And that is such a good and important point, Mike. And an LLC protects you from claims that arise inside the business. An estate plan protects you from tax exposure at death, and an umbrella insurance policy covers personal liability. Now, each of those are important by themselves, and each is doing a specific job, but they're doing it in isolation, meaning that no single one of them, rather, it. No single one of them is knows what the other is doing, excuse me. And there's specific scenarios where a claim can travel from one layer to the next and find the gap in between.
And look, we're not trying to say that it's bad planning, right? Or that it's incomplete planning, but there is a difference, and the difference is what we're here to fix. So what we're going to show you today is a framework we call the Fortified Wealth Layer. There's 3 concentric rings of protection that, when they are coordinated, create something that is generally difficult to breach. When they are not coordinated, they are just 3 separate fences with gaps between them, right? So here's what I want to ask. If we can show you in the next 30, 40 minutes that we're together, a clear picture of what those 3 layers are, where the most common gaps live, and what a coordinated version of this actually looks like in practice, then will you at least consider whether your current setup has any of those gaps? And so I'm not asking you to change anything today. I'm asking you to just to take a look at your current situation, to do a self-assessment.
Yeah, that's right. That's all we're asking is look at the big picture, then decide what it means for your situation. Because I tell people all the time, asset protection, like estate planning, it's a process. It's a process that continuously evolves over time as your business and your personal situation progresses. It's not an isolated event that happens once and then you're free to forget about it. If you do so at your own peril.
So we're going to go through a couple profiles just to kind of lay the foundation here. So I want to show you 2 different business owners. Same revenue, same industry, same level of success, 2 very different outcomes. And the difference is not how hard they worked. It's how coordinated their protection was. So profile 1, the owner has done the things you do when you build a successful business, things that you've actually done, right? LLC formed early with a good attorney, estate plan done, probably around the time they had kids, right? Life insurance is in place. The CPA filing taxes every year. Wealth manager handling the investment accounts. On paper, this person looks covered. In practice, here's what their situation actually looks like. Their CPA has not spoken to the wealth manager in 2 years. Their estate plan has not been updated since the business grew past $5 million in revenue. The LLC has 2 personal guarantees attached to it that nobody has flagged as a risk. And when they sat down with their attorney last year, nobody asked the question, does your personal estate plan know what your business structure is doing right now?
So, of course, this is not a failure of any one of those advisors. Each one of them is doing the job that they're hired to do. The CPA is filing accurate tax returns. The attorney drafted solid documents. The wealth manager is managing the portfolio responsibly. The failure here is more structural. There's no one person holding the entire picture in focus. And without that, the intersections typically go unmanaged. And I'll give you an example. Let's say you're building a house and you want to use the best materials that are available. Let's say you're going to use granite blocks. You might say, hey, granite's one of the strongest substances on earth. It's going to withstand wind, water, fire, all of it, right? But if you just stack the individual blocks on top of one another without filling those gaps with the correct amount of mortar, then when you're done, you're likely going to stand back and say, wow, what a beautiful house. This looks great. I've got a real strong structure here, until the first storm or earthquake rolls through. And because you didn't fill those gaps with the proper mortar, then the granite all comes tumbling down.
And look, it's a great example, right? And it's kind of silly. I get it. But at the same time, we're not saying that anybody is a bad business owner, right? Profile one, this business owner is busy, and busy tends to mean reactive.
And Profile 2 has the same team, the same professionals, but they've added one thing. They've added a coordination layer, the mortar, if you will, to the situation. Someone whose job it is not to replace the CPA or the attorney or the wealth manager, but to make sure that all three are aligned with each other and with each other's overall strategy. The estate plan reflects the current business structure. The entity design accounts for personal guarantees. The investment strategy accounts for liquidity that may come from an eventual exit. Everyone and everything is talking to each other.
And look, that is the difference, right? We're not talking about adding more advisors. What we're talking about is coordinated advisors. And here is the hard truth about Profile 1. The cost of that gap does not show up every year. It shows up once. And it shows up in the worst possible moment. It shows up in a lawsuit, right? A disputed contract, a health event. That is when you find out how your protection actually holds up at the worst possible time, right?
Sure.
So let me walk you through the three rings of the fortified wealth layer. So think of this visually as three concentric rings. The outermost ring is that entity layer. The middle ring is the trust layer. And the innermost ring, which is what we just talked about, was that coordination layer. Each one does a very specific job. Each one depends on the others to work properly. So ring one, that entity layer, this is the business structure. It's your LLC, your S Corp. It is a C Corp. Most small business owners aren't C Corps, but I had to put it in here. Some sort of holding company, whatever form your business takes. This is the first line of defense. It is designed to keep business liabilities from reaching your personal assets, or at least it's supposed to. Most of you have this. The question is not whether you have it. The question is whether it is doing its job.
And here's how this layer tends to fail in practice or in the real world. The first is what attorneys call piercing the corporate veil, as I mentioned earlier. This happens when the separation between you and an individual and you as a business owner breaks down. For example, commingling personal and business funds is one example of what can cause this. Not following corporate formalities, meaning keeping up with up-to-date minutes and corporate resolutions and other proper documentation, or using a business account for personal expenses is another. There's more, but many of these can, or any of these rather, can give a plaintiff's attorney the argument that your LLC is not a real separate entity and therefore your personal assets are reachable. Does that sound familiar to anybody? The second failure point is personal guarantees. When you signed a lease, a loan or a line of credit for your business, you may have signed as an individual guarantor. And understand that that document bypasses the corporate structure entirely. It is a direct line to your personal assets.
Okay, so to put this very clearly, and something I need you to hear about the entity layer, it's not enough to have it. You have to maintain it, and you have to know what you signed and how that sets you up for exposure, right? So we want to be very clear with that. So ring two, the trust layer. This is where a lot of business owners have the biggest gap because they've either skipped this entirely or they did a basic estate plan years ago that has not kept pace with what they have built.
So let me walk you through the primary trust structures that tend to be relevant for business owners at this level. Now, there's many others, but I'm going to focus on three of the common ones here for time's sake. The first is an irrevocable trust. And unlike a revocable living trust, which you control and can dissolve at any time, an irrevocable trust removes assets from your personal ownership. Once assets are in an irrevocable trust, they are in many cases not reachable by your personal creditors because technically they're no longer yours. They're outside of your ownership. The second is a domestic asset protection trust, or as some refer to it as a DAPT. Again, we love acronyms in this industry. These are established in a specific state that have favorable asset protection laws. So understand a DAPT allows you to be both the settlor and a beneficiary of the trust while still receiving creditor protection. Naturally, subject to the rules and of the various jurisdictions. So not every state allows this one, but the mechanics matter significantly when you use these. The third is a Spousal Lifetime Access Trust, or SLAT. This structure allows one spouse to transfer assets into a trust for the benefit of the other spouse, removing those assets from the taxable estate while still maintaining indirect access through the beneficiary spouse. And I know that's a mouthful, but this is a useful tool for married business owners who want to protect wealth while preserving some flexibility.
Now, I know that there was a lot of trust names. John mentioned this. It's not all of them. It's just to give you an idea, right? But here is a simpler way to think about it. The trust layer is not about being complicated. It's about putting assets in a place where lawsuits against you personally have difficulty reaching the asset, right? The specific structure depends on your situation, so you got to consult an estate planning attorney on that. But that is what the trust layer is designed to address, is your protection. So, which goes to the third layer, which is the coordination layer. And this is the one most people are missing, and I'm talking a large percentage of them. And it's the one that makes the other two actually work together.
So the coordination layer, understand, is not a legal structure or a financial product. It's simply a function. It's the ongoing active management of the relationship between your entity structure and your personal estate plan, and the regular communication between the professionals who are responsible for each one of those. So in practice, that means that your business attorney and your estate planning attorney are reviewing your structure together at least annually, and more frequently should major changes happen within your business or your personal life. It also means that your CPA knows what trusts that you have in place and how distributions from the business interact with those. It also means that your wealth manager knows the entity structure and is building around it, not in spite of it.
And so here's what the coordination layer costs when it's missing. It does not cost you anything until obviously it does, right? And when it does, it tends to cost you a lot because the gap is never the obvious one, right? It is the thing nobody thought to check because nobody was responsible for the picture, right? So that is what the whole premise is getting everything coordinated. So I want to walk you through, actually have John walk you through some questions. This is kind of the self-assessment. Obviously, it's not a test. It's just that picture for you to kind of figure out where you are in that process. And so listen to each one of the questions and, not only make a mental note, but write the answer down so you have these as that assessment. But John, let's go through these questions.
All right. So question one is, has your entity structure, your LLC, your corporation, have they been reviewed by an attorney in the past 2 years? Specifically, in the context of your current revenue and asset level. If the answer here is no, or you're not sure, that's a red flag for the entity layer. Now, question two is, do you have a personal guarantee attached to any business obligations? For example, a lease, a loan, a line of credit that you have not specifically reviewed with an attorney in the context of your personal asset protection? If the answer here is yes, or you're not certain, again, that is a red flag for your entity layer. And then question three is, Do you have a trust structure in place that was specifically designed to protect personal wealth from business-related claims? Okay, not just an estate plan, but a trust designed for asset protection. Those are two very different things. So if the answer here is no, or again, you're uncertain, that's a red flag for the trust layer. And question 4, in the last 12 months, has your estate planning attorney and your business attorney spoken to each other about you and your situation? Now, I want to be clear. I don't mean separately to you. I mean, are they speaking to each other? If the answer is no, or you don't know, then that's a red flag for the coordination layer.
So what does that mean, right? If you flagged one of these layers, you obviously have a gap worth examining, right? If you flag 2, you have real exposure worth addressing. And obviously, if you flag 3 or 4, well, honestly, I'm glad that you're here today, because what you just did in 60 seconds is something most business owners never do at all. They actually took a step back and you looked at your picture to identify some gaps. So now we're going to walk through and show you what that actually looks like when it's done right.
So here's an illustrative scenario that shows how the entity layer can fail in a way that no one anticipated. And here again is our business owner, David. We've talked about him in previous webinars. And again, I have to remind you that the suits and the bean counters want me to remind you that this is a composite example, not a specific individual. So anybody named David out there, don't panic. But it does reflect a pattern that we have seen on more than one occasion. So here's the story. David ran a manufacturing company. He has solid revenue, well-structured LLC, and a very good attorney that he's had for years. About 8 years into the business, he needed some new equipment. So he does what many business owners do. He financed it through a vendor relationship and signed personally on the financing agreement. It's not unusual. Many business owners do this. He didn't think much of it at the time. However, 2 years later, a dispute arose with that very same vendor over a separate contract. The vendor filed suit, and because David had signed personally on the financing, the vendor's attorney argued that the personal guarantee extended to the broader vendor relationship. That's important. So the LLC provided no protection in this specific context because the liability was attached to David personally because of that personal guarantee, not the business entity. By the time the situation was resolved, the legal cost and settlement reached well into David's personal investment accounts.
And John mentioned this, right? This happens more frequently than we care to kind of know, right? So, and David didn't make a careless decision. He made a very common one. The personal guarantee felt like a formality at the time, but it's not. It has consequences. And here's what a coordinated review would have caught. That document existed, that it created that personal exposure, and that it needed to be revisited or restructured before it became a problem. So the problem is that nobody was looking at the whole picture. And that is the gap that we're talking about. So different scenario, caller Carol. Obviously, this is also a composite example, but Carol built a healthcare services business over 15 years. It was very successful. Unlike David, Carol actually had done estate planning. She had trust in place, and her attorney was also an excellent attorney. But the problem was that Carol's estate plan was built around her personal assets. Her business interest, the actual equity in her company, was still in her name personally. So when an employment-related claim was filed against the business, the plaintiff's attorney looked for personal assets to pursue, and the trust protected some of Carol's wealth, but the business interest, her most valuable asset, sat outside of the trust structure because nobody had connected the estate planning conversation with the actual business ownership conversation.
the mechanics of what went wrong here with Carol are worth highlighting. The estate attorney designed an excellent plan based on what Carol owned at the time that they did the planning. Again, estate planning and this type of risk management is not an event that happens once. It's an ongoing process. The estate attorney designed an excellent plan based on what Carol owned at the time of the planning. Again, the business attorney managed the corporate structure separately, but neither one reviewed the other's work in the context of the complete picture. So the business interest, which in Carol's case represented the majority of her net worth, was not inside any protective structure because no one had been asked. Does your trust design account for your business ownership?
And it's a hugely important question that very few people ask, because Carol's situation obviously had a better outcome than David's because it was caught during a routine review before the claim became a judgment. But the reality is that's just too close, right? The lesson is not that her advisors failed her. The lesson is that nobody was responsible for that intersection that we keep talking about. And it's that intersection is where all the exposure lives. So let me bring this together before we move kind of into this next step, right? So we started the session with a simple question. Is your personal wealth truly insulated? And what we have shown you is that the answer depends on the three things working together: your entity structure, your trust design, and the coordination between the people responsible for both. Okay. Most business owners at your level have one of those. Some have two. Very, very few have all three working in concert. That is not a personal failing, I promise you. But it is a function of how advisory services are typically delivered. They're delivered by a domain, not by integration.
And that's such a good point. So what's the cost of staying where you are? The cost of inaction here isn't simply a monthly fee or a missed return. It's asymmetric, and nothing happens for a long time. And then something happens once, a lawsuit, a judgment, a claim, for example, that's going to find the gap that you didn't know was there. The probability in any given year may be very, very low, but the consequence, when it does arrive, tends to be very significant. So that asymmetry is exactly why proactive coordination matters, and why waiting for problems to surface is a strategy with a very specific kind of risk.
And look, this isn't something you bury your head in the sand and, hey, I'll do it tomorrow, right? Because doing nothing is a choice, right? So it just does not feel like, one until it's too late, right? That's the whole point. We don't want to wait until something happens. So here is where we are. Like, right, you came today thinking about protection as a structure, at least my hope. And so I hope you are leaving with a different frame around this conversation. And that frame is protection is a system. And obviously, systems require coordination. So if you want help building or auditing that system for your specific situation, that is exactly what we do. And I want to tell you more about that and how that looks as we go into this next slide here, right? So obviously at the beginning of this, we made a deal. Well, at least I made a deal with you. And that deal was, our goal was to teach you something that is useful that you could take into your business right now and ask your professionals questions today that impact your business. Okay. And that if we delivered on that educational promise, then we were going to ask you if you needed help to schedule time. And so, one, I hope that we delivered on that education. And so naturally, if you need help, that's the next step. So we're offering a complimentary value gap assessment. It's a working conversation, typically 45 minutes to an hour, where John and I kind of get to know your situation well enough to tell you where the gaps are most likely to be and which of the specialists in our network is the right fit to help you address them. But once again, we've got some compliance. So before I tell you about that, I kind of want to hand it over to John real quick and kind of talk about some of the additional final compliance notes.
Thank you, Mike. So Mike and I are not your asset protection attorneys. We are not certified exit planners or valuation experts. So what we are not going to do is sit down with you and draft a trust document or restructure your LLC. What Mike and I are is the coordination layer. We are the people who look at your full picture, keep it in focus, who understand what each of your advisors is doing and who can identify where the gaps are and connect you with the right specialist to close those gaps. And I want you to know that we've built a network of attorneys, CPAs, business consultants, financial specialists across all disciplines for exactly this purpose. And our job is to make sure that the right people are talking to each other about your situation and that everyone is aligned with your overall strategy. So think of us as the quarterbacks here, not the entire team. And what we bring to the conversation like this is a vision to see the whole field. So Mike, with that said, why don't you tell them what a value assessment conversation looks like?
Super. So it's a listening conversation first and foremost. Like, we want to understand what you have built, where you are in that business journey, what advisory relationships you already have, and what you feel is working and not working. We are not coming in to critique your current team. We're not coming to ask you to fire your current team. We just want to bring that team together to help them for you to understand the full picture. And so by the end of that conversation, you leave knowing who you should be talking to next and what that conversation should focus on. That is the value, right? So the point of the conversation is to get more clarity on what the next step is, what the next process is, and who the person you need to be talking to.
And I'd like to add to that, that network that we bring to the conversation is not a list of generic referrals that we just pulled out of the sky. These are professionals that we've vetted and have worked with directly, who understand how to collaborate rather than just operate only in their lane or in their individual silos, as we've said in previous webinars. That's the difference.
Perfect. And so super simple, booking the conversation. You see the QR code on the screen. You go ahead and scan that. It does open up our calendar link. Find a time that works best for you. You can also reach out to John and I directly here on LinkedIn. I'm happy to we're happy to send you the calendar link as well. It takes 30 seconds to schedule time. So if you're watching the replay of this session, the link will be available in the description, but obviously the same process. Scan the QR code, click the link in the description, pick a time that works best for you. Before we close, let me give you a look at where we're headed to in the next session, because we do these every other week. Webinar 5 is called Cost Reduction as a Valuation Multiplier. Most business owners think of cost reduction as just firing employees or cutting back on lunches. This is a much more robust and depth in terms of cost reduction. And the core idea is that every dollar you remove from your operating expenses does not just improve your cash flow, but it also improves a 5 times multiple as it adds $5 to the business valuation. It's a pretty big claim. We'll get into that. So we're going to show you specifically where that hidden cash tends to live in your business at your level, and how a coordinated advisory team, John, that's a theme here. Coordinated advisory team helps you keep it and or find it and keep that cash flow. So if today was about protection, webinar 5 is about acceleration. And so I'm going to be very bold and say you do not want to miss that.
Yeah, good stuff right there. The date and registration link for webinar 5 is going to be found on our LinkedIn profiles after today's session. So go look there. Don't go there right now. It's probably not there, but it will be there later today. And by the way, if you missed any of our previous webinars in this series, You can find them on our YouTube page at Avior Wealth Management.
A lot of great information on that page. So that is our time today. We want to keep it short, keep it educational. Do appreciate you being here. This series is built for you, and this conversation is exactly the reason we do it. If we hope you found it valuable. Book that assessment, take the next step, and we'll see you in webinar 5.
Thank you, everyone. We appreciate your time today.